welcome. You're watching Financial Planner and we're talking to Feroze Azeez about a specific product which is not very popular in the market just yet, but of course picking up steam. Feroze, I want you to talk about structured products, and no better person than you to have this conversation with. First, start by telling us what are structured products.
See, structured products are nothing but bonds. But they are called debentures, not just bonds. If the government issued, they're called bonds. But bond is a more popular nomenclature to describe a debt instrument. So structured products are debentures which you buy from a corporate, which does not have a fixed coupon like most debentures have 8, 9, 10% as the interest. The structured product has a variable interest, a variable coupon, depending on the Nifty levels. For example, if you've taken Nifty as the underlying. To summarize, structured products are debt instruments which have a variable payoff related to equity. And it is for every level of the underlying, in this example Nifty, you have a specific payoff for that structured product. So this is of course a 12-13-year-old industry. In 2006 is when India had the first structured product. Now I personally think this is one instrument, like you rightly pointed out, Samina. It's not very popular, but to my mind has to be in most people's portfolio if they can afford to invest 25 lakhs and upwards.
Feroze, okay, let me understand this, right? We invest in mutual funds for wealth creation. We buy stocks for wealth creation. What is the basic purpose that investing in structured products does? So, I mean, what should be your objective before you invest or buy a structured product?
So there are two points to answer that question. Point one, like you rightly mentioned, the vehicles to participate in equity and create wealth are buying stocks yourself, buying a mutual fund / PMS. These are the two methods of participating in the growth of equity. But one thing to note here is all these three methods, PMSs, mutual funds, and buying stocks yourself, have human intervention. Human intervention brings immense emotions and not just rationality. There is enough theory to prove that human intervention is overwhelmed by fear and greed. So structured product, on the contrary, as I was highlighting its importance, is a mechanically managed instrument. It does not have human intervention. So if I look at the ticker of Nifty, I would know what money I have made. So if I peg my life to a certain portion of my portfolio to the largest index in the country, and with zero human intervention and mechanical management, does it deserve 30-40% of my portfolio? To my mind, 60% can be human managed, 30-40% has to be mechanically managed, because humans are a big statue of emotions. Point one.
You've already told me what the composition of a structured product is and what is the minimum ticket size. What is the sort of returns one can get in a structured product, and do structured products need to be held to maturity? So what's the timeline that one needs to look at when investing in a structured product?
When you're investing in a structured product, the other very important thing which you have to keep in mind before you get to the ticket sizes and also other factors is to say that it is your plan B. Plan A is market will do wonderfully well if things go right. If things don't go right, what is your plan B? So structured product in a portfolio construct serves the purpose of a plan B. Why am I saying this? So you have to make a choice in a structured product which is complementing your current portfolio and buy products which can give you returns in mediocre markets. So what can one expect? He or she as an investor can expect 13 to 17%, but not needed for the market to go up 15% per annum. Even if the market went up 4% an annum, a structured product can deliver you 17% an annum. So it becomes your plan B. In life, minute things we plan for a plan B. If we go to a restaurant and say, if I don't get a reservation here, I go, what's my plan B? So investments need a plan B, and structured product helps you plug that massive gap of a plan B, and the return could be ranging between 13 to 17%.
Right, Feroze, very quickly tell us about the various types of structured product and what's the composition, if you just want to give us some more details if you've not already covered it.
Yeah, so point one, there are conservative structure products, there are marginally aggressive structure products. So ones which are conservative, we call them debt structure products. If they are aggressive in nature, we call them equity structure products. So these are the two types of structure products, but both of them have an underlying of Nifty. It's about the risk appetite, which classifies them as debt and low risk and high risk or medium risk. So that's point one. Composition is, it has a large portion of money in debt, and a certain composition or component of money is also in derivative. So this combination gives you the output, which is shown to you in the form of a graph, so that you precisely know what you would get in which situations.
Feroze, just move on from there and tell me, so when you have a mutual fund, you have a fund manager who sort of manages the fund, right? Who looks after a structured product? Do you have fund managers here too, or I mean, how is this managed at the end of the day and designed also, right? I mean, who determines what is the composition?
Yeah, the nomenclature used for the people in the back end for a structured product are called traders. The difference is, in a mutual fund, every day the fund manager has something to do. But a trader, when he designs the structured products and delivers the structured product to a person who's an investor, he or she as a trader will have to only do the designing part on day one and stay static for the subsequent 3 years, assuming you have a 3-year structured product. So there is no continuous management, there is creation, and then the trader waits for time to lapse, and at maturity has to do one activity to return the money, unless the investor recalls his money, which is also possible in a structured product. So trader is the nomenclature. Point two, trader designs it, and their work is only on day one and day n, which is the end point, unless the investor says, I want my money midway.
Feroze, I can imagine this being extremely popular amongst the ultra HNIs, right? Is it catching attention amongst retail investors as well?
I think when the importance of structured products is correctly described to people and its relevance to a portfolio construct to manage risks, then even not an HNI, ultra HNI, even an HNI, maybe sometimes 1 crore plus portfolios deserve this money. And since we have been doing this business for 6 years, if I see the trend, the participation from 1-2 crore ticket sizes, which are not called HNI in the country, has enormously increased, provided they understand this instrument more clearly and its relevance.
It was also, I mean, when you invest in another instrument, you have a lot of past performance, the fund manager's investment style, composition. Those are the sort of parameters one looks at, or we recommend them to look at before they invest in a sort of mutual fund. How does one go about investing in a structured product? Is it past performance that you'd look at? Is that one of the key sort of parameters to look at, or that doesn't matter here?
It certainly does, Samina. The capability to deliver the product has to be judged for the organization and also that specific product category. So, for example, now there are about 4-5 issuers who issue structured product in India. We get a reasonable mobilization out of it. So we are, in terms of mobilization, one of the largest or the largest. Having said which, you will have to see how many structured products of that specific issuer have matured and how they have delivered. So we have about 250 of them having matured. So you will have to ask your advisor, what is the ratio of those products which were done in the past and they've matured, which have done well. Second, for example, there's something called the protected call, which I am doing the 200 series. So you have evidence of close to 100 of the same category of product which has matured. So to answer your pointed question, should you look at past performance even on the product category and also the issuer category or the issuer in specific, without which you should not venture into buying a structured product for sure.
Feroze, assuming our viewers have watched this show and want to know where they can go get these structured products from, how does one go about, buying these structured products, and who are the key issues in the market who do this?
So if you arrange them in gross mobilization per month, Anand, Rathi, Edelweiss, Reliance are 3 big issuers on the domestic side. Citi is another issuer on the MNC side. These are the prominent names who issue structured products in the country as we speak. So a person can go to any of these three issuers. Of course, you can come to Anand Rathi as a viewer or an investor to understand more. But the most important thing for a viewer is understanding it before venturing into it. Because if something is unique and new, you will have to do your homework to embark on the journey of having structured products in your portfolio, and then go through the learning curve and then scale it up to the deserving portion, which in my mind is 30 to 40%. And my monies personally would be upwards of 50-60% in structured products at this point in time.
Right, thanks, Feroze. I know, Anand Rathi is a market leader in structured products. Of course, if you're seeking some more information, would like to sort of purchase a structured product, they will be the right people to assist you and help you execute the process. With that, we're out of time, but thanks for watching.